Recently, I've been coming across a lot of material on special assessments on condos. And so I thought I'd do a quick video just to explain a little bit about special assessments and what your options are financially for them. So if you are a condo owner, there is the chance that a special assessment will happen. And what that is when your reserve fund, there's just not enough money in your reserve fund to cover a major repair. And so the management company will decide to either put out a special assessment or for the entire building to go and get a big loan. And then that loan would be divvied up depending on your square footage, and you would be looking at an increase in your maintenance fees over X amount of years. Okay, so in order to do that option, a certain percentage of the owners have to agree to go that route. If you don't have that percentage agreeing to it, then each unit will be given an amount that they have to pay, and normally they have to pay it within 3 months, 6 months, or a year, depending on what the timeline is. Okay, the great thing about doing the special assessment is that it does not go onto your title. It doesn't affect your status, search, and all of that stuff. You, as the condo owner, would be responsible for financially taking care of that amount. So for some people, it is quite a bit of a financial hardship to be hit with a 10K, 20K, 30K amount. And depending on the duration that they let you or give you to pay that back, you're looking at several thousands of dollars in lump sum amounts. So I have a condo in downtown Toronto, and I was recently hit with a special assessment as well. So I've experienced it now firsthand, and I'm still going through that process. I've also experienced it before with some friends' condos as well. So in terms of trying to find out how many condos have special assessments, or what percentage of condos, so that when you're buying a condo, if you knew that 75% of condos will have a special assessment, then at least you could plan to, have 30K available for something like this to happen, because it will happen. So unfortunately, there's no such report out there that we could find saying what the percentage of condos will get a special assessment. Part of that problem is because some reserve funds are big enough to cover that that construction amount or that renovation amount, and so they haven't had to go through the special assessment route or go through a construction loan or register it against the property. So those are those management companies, obviously then are run really well so that they have sufficient funds to cover a major renovation like that. So in terms of options for individuals when they are hit with a special assessment, you can take the time to call your meetings, get your lawyers involved, and try to get all the other owners rallied to, get more information and to put other options out there in terms of tenders and different types of contractors and so forth like that. But the end result is that at some point you're still going to have to come up with some money. Okay, so let's look at the couple of different options. And one of the reasons why I'm doing this is, in my unique position, I look at numbers all the time. And one of the things that I was asked from one of my neighbors last night, which is why I decided to do this video, was they came over and asked me, "Hey Huong, is it better to use my line of credit, or should I try to add this amount to my existing mortgage? What are my options? What is the best way to go?" Okay, so it really, and of course for everybody it's different. So I do advise that, after you listen to me, go and seek another individual's advice. Like, talk to your lawyer, talk to your accountant, talk to other owners within your building to see what else they're doing. Okay, because maybe, I have a couple of ideas, but of course some of them won't be valid for you. Okay, so let me go through just a couple of the quick ones, and once they're out there, then they're out there, and you can just throw it out the window if you don't like the idea. So the first one is to use your tax return, and that's assuming that you're going to get a huge chunk of money back from your tax return, which a lot of people don't. So, but if you get $2,000 or $3,000, that and put that towards your special assessment, that does go a long way. Okay, so the first one is to use your tax return. The second one is to look at getting a part-time job or a contract job just for a couple of months to help you get the extra funds that you need. That option is not for everybody, depending on what your family situation is or what your current job situation is. Okay, but of course that is an option. The other one is to use your credit card. This is not one I would recommend, but it is an option, of course, for some people. And the reason why I would not recommend it is just because of the high interest rates. Some people are paying anywhere from 15 to 22% on their credit card. The other option is if you have a secured line of credit against your home, so you've got access to a HELOC or a line of credit, and that is tied to your home, the interest rate on that is normally about prime plus 0.5 or prime plus 1. So at the most, you're looking at maybe 3.5% interest rate. So that would be the best option, is to just take the funds from your line of credit and pay your special assessments off in the installment options that you're given. If your line of credit or your HELOC is not secured against your property, then the interest rate is probably higher, maybe around 7 or 8%. And then that's where you would have to look at your option of pulling those funds from your line of credit at 7 or 8%, because that is higher than what it is if it was secured against your property. The next option is to add it to your existing mortgage. So keep in mind that in order to add it to your existing mortgage, you would have to go to your current mortgage holder and ask them to increase it. They might just say, hey, you know what, we'll give you a line of credit secured against your property at prime plus 0.5. That would probably be the easiest way, okay, because the qualification process for that is normally a little bit easier. If they don't have that option and you want to add it to your mortgage, then they might need you to basically reapply for a mortgage again. So it's like obtaining all your documentation and requalifying at the Canada benchmark rate of 4.64, right? So it really depends on your lender. So keep in mind that if you are going to add this to your mortgage and let's say spread it over 25 years, the thing to keep in mind is that, let's say your special assessment is $20,000. At 3% interest rate over a 25-year term, let's say, it takes you 25 years to pay it off, you're looking at about an extra $100 a month or $95 a month, okay? So, which isn't a big deal, but keep in mind that because you're paying 3% your interest rate is 3%, you're paying compound interest on that $20,000 that you've taken a loan out on. So in the end of that 25 years, that $20,000 is not just $20,000. It's actually $28,400. So roughly about that amount. So your $20,000 loan has gone up by almost $8,400. So when you do the math on that, that's about a 42% interest. Okay, so if you have the ability and the access to funds to pay it off within the next year or 2 years, I would say do the line of credit, because the compound interest will only be for the year or 2 years. If you add it to your mortgage, you're looking at doing the compound interest for the 25 years. Okay, so the other thing to keep in mind is that you have the 20 years or 25 years to pay off your mortgage, but keep in mind you also have options within your mortgage to pay it off faster. So when I was talking to my neighbor last night who asked for this information, they were not aware that they could that there were other options to pay off their mortgage faster. Okay, so I'm not going to go into it here. I'm going to actually do a separate video to explain that, because there is one other option that I want to mention that might be feasible for some individuals in terms of paying off their special assessment without getting a mortgage. Okay, and this is called an RRSP mortgage. So the way this would work is that you would have to have $20,000 or $25,000 of RRSP yourself sitting in an RRSP account, and another owner who's in the same situation as you who has to pay a special assessment off. also has $20,000 or $25,000 sitting in their RSP account. Both of you do a trade with your RSP. So let's say in this situation, my special assessment is 20,000 and there's another owner who has a special assessment for 20. We both have RSPs of $20,000 available. Okay. What I would do is I would lend that owner $20,000 from my RSP. I'm not taxed on it because it's not a withdrawal. I am doing a mortgage for that individual. That person would do the same thing for me. So it'd be in return. We would both agree on the same interest rate, whether it's 3% or 4%. But we're not paying each other, we're just paying ourselves. So rather than having our current RSP sit in some investors group or some other company, we take that RSP, we lend it to somebody else, and we pay ourselves that 4%. Okay, so there is a process of doing that. It's not as simple as just going to your current RSP company and saying, okay, I want to do this. There's only 2 companies in Canada that allow you to do this, and so you'd have to transfer the funds in kind to this company, and then the other owner would have to agree to do the same. And then in addition to that, there are lawyers' fees. So you'd have to pay, I don't know, anywhere from $700 to $1,500, depending on how much your lawyer will charge you. And then there's also a little bit of administrative cost. You're looking at about maybe, let's say at the most $400 to $500 for the year or 2 years time frame. But and then the other thing that you also want to keep in mind is that you want to do this with another owner where both of you sort of agree on the timeline, so that whether it's a 2-year or a 3-year arrangement, and that each of you guys would pay that off, right, in 2 or 3 years. And because you're using your existing RSP, you just pay it off that way. But it has to go back into your RSP. If you take the payments out yourselves, if the other person pays you for that and you don't put it back into your RSP, that counts as a withdrawal and then you're taxed on it. Okay, so that option is called an RRSP mortgage. And yeah, so I can definitely give, if you are interested in that option, please reach out to me and I can try to explain that a little bit better. I'm just sort of talking off the cuff here. So now the other thing with the RSP mortgage is keep in mind that you would have to register on title for that. So if you currently have a mortgage, let's say with one of the banks, that's fine. Then you would just, as part of the legal process, is also then put a second mortgage saying, for the 28,000. That it's coming from this other individual, this other owner, right? And it'd be identical for them. Okay, so those are some suggestions on how to deal with the financial payments for a special assessment if you're in a situation where you're hit with a special assessment due to a major renovation. Thank you very much for listening.